Good morning, good afternoon, good evening. I'm Luiz Pereira da Silva, the Deputy General Manager at the Bank for International Settlements, and it's a pleasure and an honor participating in the China 2021. So I will be speaking about the challenges for the financial system after COVID and under climate change. I will touch upon three topics: new challenges for financial stability arising from climate change, new financial technologies, how they can reduce inequality, and they can also help to finance climate change mitigation and transition. Finally, talk about green projects and green finance and their role in helping to foster a green recovery. So on the first topic, I think it is not anymore why finance needs to help combat climate change. It's now how can it help? And this comes from a recent positive evolution of mindsets, particularly inside the central banking community, because people are realizing that there is no single actor, no silver bullet to address alone the challenges posed by climate change. You need to coordinate with other actors, particularly governments, but also the private sector. And you can do this within the existing roles and mandates of economic actors in society. Indeed, for example, within central bank mandates, climate change directly impacts financial stability objectives and also price and macroeconomic stability objectives of central banks. So increasingly, central banks are aware of the need to address climate change related risks. And of course, other agents are also moving in civil society, in the private, real and financial sector to help address these challenges. There is demand for transparency, for consistency of policies. There is also creativity in the supply of new financial products. The central banks and particularly the BIS have been coining a new systemic risk concept for climate change. We at the BIS have talked about green swans. It is different from the black swans of the global financial crisis because it is not anymore about events that are very rare and the tail of a distribution. Climate change is almost certain, if not certain, to happen if we do nothing to stop the emission of greenhouse gases. They are going to be triggering catastrophic events, particularly what we have been observing recently as weather-related events, extreme events, and they are essentially triggering now tipping points beyond which it is impossible to control the cascading effects that climate change will pose to society. So therefore, the usual wait and see prudent attitude to see if changes will happen spontaneously are not warranted anymore, and they are very risky. So even with the uncertainty that we have about climate change, there is an asymmetry of risks posed by green swans that require immediate actions from the community. We know, for example, if we observe the path of our greenhouse gas emissions, very soon we will reach a very high and unsustainable level of concentration of CO2 in the atmospheres that would particularly challenge the way in which we organize our societies, our production patterns, our consumption patterns. It will trigger, if we do nothing, the impact on temperatures in zones of the globe where we will not be able to live anymore. If you see in this graph, the areas around the tropical areas of the globe where you have a huge amount of populations that will become inhabitable because of the rise in temperatures. It will also trigger, with physical and transition risks related to climate change, a set of very complex events that is very difficult to model in terms of risks. For example, the melting of polar ice sheets, or the change in the Amazon rainforest, and the changes in thermal line circulation in the Atlantic, for example. So facing that, the community of central banks are actually doing quite a bit. They are continuing to improve analytical tools to assess climate change related risks, and also the resilience of our economies and our financial sectors. They are investigating how they can use their policies to reduce the risks posed by climate change. They are also looking at disclosure and accounting standards, and they are improving the taxonomy on green investment products, as well as greening their own financial assets. Now, of course, beyond that, we have to think of how new financial technologies can improve inclusion and reduce inequality, because there is a dimension of redistribution that is related to climate change. New finance technologies can bring more inclusion and change policy design. Of course, we know that faster payments are at lower cost, for example, through the usage of our smartphones, can contribute to increased financial inclusion, together with digital identity, with the usage of artificial intelligence. All this can reduce poverty and inequality. When you reduce poverty and inequality, it can help to mitigate the effects of climate change, because we know that these effects are largely regressive. They affect poor countries most, and poor households in rich countries first. So in fact, these new financial technologies can play a double role. They can help to finance mitigation and transition strategies with the more precise assessment of carbon footprint, and they can also help to finance new projects of alternative energies and move towards a low carbon economy. Of course, they have also other types of risks in terms of, for example, digital discrimination that need to be monitored, but this is something that also the community is considering. Illustrations of how finance can achieve gains in inclusion. This is the path of progress in GDP per capita, measured against the number of account ownerships as a percentage of the population. And you can see that digital finance can improve significantly, can shorten the path for countries, for example, like India, that instead of taking many years to reach financial inclusion, have been jumping with the possibility of digital ID and the new finance technologies. Technology can also allow for real-time instant payments. It can reduce the fixed cost of transfers for poor households and increase the speed for small financial transactions. This is the comparison between the classical RTGS system development and also what is happening with fast payment systems. And technology can also reduce the cost of migrants and remittances. This is very important for many developing countries. You can see in these slides that the cost of money transfer operators have been falling thanks to financial development and payment innovations. Now, of course, there is also an aspect, as I was mentioning, that needs to be monitored. Is the fact that when you have concentration in an industry, for example, with big techs, It can also create potential further inequalities, for example, in wages in the technology sector. You can observe this in the right graph of this slides. The wages in technology sectors have been rising more rapidly than other sectors. This has to be also monitored. Finally, how green projects and green finance can help a green recovery. In accelerating the pace of the recovery towards a more greener type of growth. If you look at this stylized representation of GDP in the post-COVID recovery, you can see that you can have either a more slow, brownish type of recovery with traditional types of consumption and investment patterns, or you can consider that with green finance, you can push innovation up. And then with these innovations and new investments and new alternative sources of green energy, you can perhaps have a recovery that will be faster and with a lower carbon content than the traditional ones. And financing the transition, financing the mitigation and adaptation can contribute precisely to help to push up this recovery with a lower carbon content. A few examples of that are already happening. The public financial sector, for example, development banks and international financial institutions are working in fostering new green investment projects and accelerating the transition. And you have many examples of green infrastructure that are being favored by green finance, urban forests, rain gardens, and so on and so forth. There are multiple examples of how this is already happening. It's not only the public sector, also the private financial sector can provide new financial instruments to help change the behavior on the demand side from consumers and also on the supply side from investors. And I'm sure you have observed that the private sector is eager to invest in new green financial instruments, including through ESG and green bonds. But the private sector needs a better taxonomy on green financial instruments, and this is something that is already happening. And meanwhile, the direct co-financing with the public financial sector, private-public partnerships, and research partnerships are underway to facilitate this transition process. There are concrete examples of initiatives in sustainability and anti-COVID finance, such as the net zero emission coalitions, the net zero asset owner alliances, many things that are happening also in Europe, in Asia, and in the Americas through a set of policies to recover the post-COVID economies with a lower carbon content, particularly on the infrastructure side. As a conclusion, I think we should use the tragedy of COVID-19 as an opportunity to aim at the green recovery. We know that COVID has produced an unprecedented contraction in the world economy that, in fact, we anticipated with climate change, physical and transition risks. So never waste a crisis. The recovery can aim at being as green as possible. On the demand side, for example, consumers are becoming more selective. They have now better information and they have better incentives now to favor a lower carbon economy. There is also a rising awareness of the risks posed by climate change. On the supply side, green finance investors are offering new practical diversification projects and new paths to lower carbon in the recovery, and also to have available products to finance a transition to net zero. Now, of course, I would end with a warning. We know that a low carbon economy requires a transition, this transition to net zero has distributional consequences in terms of who are going to be affected by some of the necessary policies to lower the carbon content of our production and consumption patterns, and therefore we need to think of these distributional consequences as well. So thank you very much for your attention.